Now we have now we got to think a little. This is going to be a little more challenging. We're going to look at 3 different companies, very different companies. Tiffany & Company, Walmart stores, and Ford Motor Company. Let's talk about each company for a moment. Tiffany & Company. Is anyone familiar with Tiffany? Yes. What is business is Tiffany in? Jewelry business. Anything particularly interesting about Tiffany? It's very high-end. Very expensive jewelry, like jewelry for celebrities and stuff. They have, and what would you say in terms of their business strategy? What is their business strategy? I have a student who works there. It's an accountant in their accounting department. What would you say is their business strategy? You know, we talked. Let me rewind a little bit. We talked about soft drinks and PepsiCo last time. What did it emerge? What is PepsiCo's business strategy? Sell cheap, fattening junk for as much money as they can, right? That was the basic strategy. Is that this can of soda? This is not a Pepsi product, but this can of soda costs nothing to make, and you sell it for $1.39, $1.50, $2 maybe, and it's just junk. And everything else that they sell, in general, it's the cheapest, junkiest. I don't want to say the cheapest, junkiest ingredients, but it's not premium. I mean, it's oats. Oats is, you know, people used to feed oats to their horses. Oatmeal, you know, even, or pretzels and potato chips. It's all fairly cheap to purchase for them to make, and then they sell it at a premium. That's their strategy. And how do they get the prices up? With really good marketing. Well, what would you say Tiffany's marketing? What's Tiffany's strategy as a business?
High quality.
Very high quality. What else?
Lower volume.
Low volume. And I'd say marketing the product so that it has an aura to it. It has a certain aura to it. Oh, it's from Tiffany's, you know? And, you know, they got the little blue bags and the little blue boxes and stuff. And another thing about Tiffany is they don't have sales. They don't have sales. It's not like, you know, I don't want to say that I'm a cheapskate, but when I bought my wife a ring, you know, there was a lot of negotiation involved. And, you know, I went into the city and I went to all these different dealers on, you know, in Midtown and kind of negotiated, you know, oh, well, this is nicer and stuff. And then that's not how you buy a ring at Tiffany. You buy a ring at Tiffany and, you know, the price is the price. That's it. It's not something to be played with. How about Walmart stores? And by the way, the price is high. If you notice something at Tiffany, it's pretty cool. They don't wrap. You know how most stores, when they sell stuff, it always ends in 99 to make you think it's a little less money. You know, this is $1.39, and like, oh, it's not $1.40. It's only $1.39. You know, and $19,999 for a new car or something. You know. Well, Tiffany doesn't do that. It's $20,000. This ring is $70,500, and you know you're going to pay every cent of it plus tax. So that's the strategy there. But what about Walmart? What's Walmart's strategy?
You put an old man in front of the store and greet you.
Yeah, they got a greeter, and everything there is 99 cents, right? Everything there, all the prices there ends in 88 or 99. Why? Yeah, there's a psychological thing. If something's $1.99, you don't realize that it's only 1 penny less than $2. There's something psychological working there. I'm not a marketing person, but that's just how life is. So what they want to do is, when you go in there, right, what's their slogan? Save money, live better. So you want to go there for low prices. It used to be always the low price. Before that, it was always the lowest price. But then that wasn't true. So it was always the low price. And now save more, live better. So the idea is you go there for low prices. And what's another piece of their strategy? Everything is in one store. You don't have to go to the supermarket and you just go to a drugstore and all these, everything is in a single store. What else? They move merchandise, a lot of merchandise, right? Tiffany, you walk out of there with a little bag, right? If you're lucky. But Walmart, you walk out of there with a really big shopping cart full of stuff. And you load it into your minivan. A lot of stuff. And ideally, you buy big quantity stuff. You know, Costco-sized containers. We could talk about Costco, because Costco is really like Walmart on steroids. Very low prices, huge volume of merchandise that they move. And that's the Walmart strategy. Move as much merchandise as you can at as low a price as possible. And something Walmart does is pretty cool, is they lower the prices sometimes. Tiffany, it's unthinkable, right? They lower the prices. That if they can they work with a manufacturer to reduce the price of something by 10 or 15 cents, they'll do it. Get the price as low as possible. So the profit margin is very low, but they'll sell you so much stuff when you go and visit that they will still make money off of you. How about Ford? Ford Motor. Anyone here drive a Ford? 2 people. Okay, that's more than I get in most classes. What's the Ford strategy? Yes.
The Ford, isn't it to make as much of a product as possible, to sell it cheaper?
High volume, low price?
Yeah. That's like Ford has done that ever since like what, 1980?
Okay, why do you drive a Ford?
Because my dad bought it.
Isn't it because it's an American made?
Buy it because it's made in America?
Yeah.
Why would someone buy a Ford? Don't ask me, I drive an Acura.
Well, I drive a Honda, so
So you don't know. So why I don't want a Honda. Why do you drive a Ford? Why do you drive you drive a Ford, right? Why?
It's just what I got cheap.
Well, you got cheap.
Yeah.
So low price, high volume, huh? Why do people buy? Oh, you have one also?
I used to have a Ford.
Yeah.
They're marketed on their dependability.
On dependability?
Yeah.
I had a Ford too. I had a 1990 Mercury Marquis, Grand Marquis. You know the boats? I had a boat. It was awesome. It was awesome. And my wife is like, "What's wrong with you? Why are you buying this?" I'm like, "It's $800." Shh. And students would come in. I use it as an example. I said, "Okay, my car weighs 2 tons and it costs $800. Your BMW weighs 1 ton and it costs $35,000. I got more car for my money than you did, you know." And then I figured out, the cost per mile of driving an $800 Ford Mercury Marquis. So why do people buy new Fords? We're joking around, but why do people buy why would someone buy what are some of the Ford models?
Well, they have every type of model you can imagine.
Yeah, they do. So let's just pick a model at random. I don't even, the Ford hybrid? A normal one, like an Explorer, an F-150, no, like a Ford Explorer, okay? That's like a normal Ford, right? A Ford Explorer. Why would someone buy a Ford Explorer? Family? You can fit the whole family in there. Why else?
A good fuel economy for a truck.
It gets good fuel economy for a truck. Nothing else?
It's high-end technology.
Technology? Right, one of the things they have, Ford supposedly has a really good, the stereo connects with everything, and, I don't know, you can connect your iPod to the stereo and get satellite and all these other things. So there's certain reasons why somebody would buy it. We're going to look at that for a second. So we said Tiffany is high price, low volume. Walmart is low price, high volume. Where would you say Ford is? Compare with other auto manufacturers. So it's probably somewhere in the middle because they have more premium cars, right, like Lincolns, and then they have cheaper cars like Fusion, is it? Ford Fusion, is that the assets? Who do you think has the most liabilities? Ford also? Why do you say Ford?
Recalls and stuff like that.
Recalls?
I think it's like that processing jewelry is, I think, it's a lot more work. That's why jewels are so expensive. And since jewelry does not sell as much as
Uh-huh.
as often as maybe like a Ford car, I think there's more liability.
All right, so we'll go with a vote. How many people say Tiffany? Two. How many say Walmart? No one, huh? How many say Ford? A lot of people. I'm going to estimate 12. How about revenue? Who has the most revenue? Think about it. How many people said Tiffany? No one. How many people say Walmart? Most of the class, huh? How many people are in this class? Let's say 16 people. How many say Ford? How about profit? Who has the most profit? Tiffany? 2 people? Walmart? 12? Ford? Is that a hand or just a finger? Okay. That's your votes, huh? Let's see how you did. Total assets. Walmart has the most assets. Ford has the most liabilities. Revenue. Walmart has the most, and Walmart by far has the most income. So Walmart had assets of 180, are you ready for this? $1 billion. B, with a B, not an M. $180 billion. As opposed to Tiffany has assets of $3.7 billion. Ford has assets of $164 billion. Total liabilities. How much liabilities does Tiffany have? Not much, 1558. Walmart was 112,000 and Ford is 165,000. And then here, in terms of revenue, Walmart blows everybody away with 421, and this is in millions. So $421,849 million would be $421 billion. Get that with a B. Net income, $16,389 million. Walmart. Tiffany is a little screamily, little tiny, little $368 million. That's like nothing. You could win that in the lottery in a year, you know. Ford, $6,561,000, somewhere in the middle, like you guys were saying over here. Okay, so we have, let's look at debt ratios. Now, what we want to do with these numbers, and this is really key, is we want to begin to understand things about the company because we want to be able to make investments. So we want to understand how profitable is the company. And part of the problem here is that companies of all different sizes. So you might look at Tiffany and say, hey, Tiffany has $1,558,000 liabilities. You say that's not much liabilities, but does the company have too much debt? Has it borrowed too much money? Because it's smaller, you can't really compare it directly with Tiffany or Walmart or Ford because Tiffany is so much smaller than Walmart and Ford. So what are you supposed to do? And what we do is we use ratios. And the ratios give us basic figures that we can use to understand different characteristics about the company. So a good comparison would be to batting averages in baseball. in baseball, you say who's a good hitter, who's not a good hitter. And you can immediately work up a batting average for any baseball player. And simply by looking at their batting average, you can see how good a hitter they are. This way, let's say you have some players who play in every game, and you have other players who play in every, don't play very often at all. You could still compare their batting average because the batting average is the same. It's the number of hits divided by the total number of at-bats. Even I know that. I don't know much about baseball, but even I know that. So that's why having a ratio is so useful. And then you can also compare, you can not only compare batting averages for different players, but you can compare batting averages over different years. So for example, what you could do with a given player is you could look at their batting average every year over their whole career. And then try to understand, okay, have they gotten any better? Have they gotten worse? And stuff like that. That's why ratios are so useful. So the debt ratio is the first one I'm going to introduce to you. It's total liabilities divided by total assets. And the way you would calculate it is, you just divide liabilities by assets. Tiffany has shown to you right here. 1558 divided by 3736 is 41.7%. So now try it out for Walmart and for Ford right here. Total liabilities divided by total assets. And you get 62.06%. Try it again for Ford. You get 100.41%. And again, as I'm doing this, please do it yourself with a calculator so you can start to remember and understand these formulas. So what can we divine from these formulas? What we can see here is that the numbers are dramatically different. Ford is 100%. It has a lot of debt. Walmart's 62% and Tiffany's 41%, meaning that as a proportion of total assets, Ford has a crazy amount of debt, whereas Tiffany has the lowest ratio of debt. So Walmart is primarily financed with debt or equity. Debt, because the ratio is above 50%. Most of their assets come from debt, resulting in a debt ratio that is less than or more than 50%. More than 50%. Whereas a company primarily financed with equity with a debt ratio that is less than 50%. Ford has a debt ratio greater than 100%, indicating its liabilities are greater than its assets, which is crazy. I mean, think about it. If you had assets of 100, let's say you had assets of $50,000 and liabilities of $51,000, you would be in trouble. Now, return on sales is a measure of, debt ratio is what we call solvency. So you have enough debt. And you can see that Walmart has a crazy amount of debt. What's dangerous about having too much debt?
Not being able to pay it back.
Yeah, you might not be able to pay it back. And if you can't pay back your debt, then, if you don't want to invest in a company that can't pay back its debt. Because if it can't pay back its debt, then you're never, ever going to get a dividend. Sorry. Now, return on sales is a measure of profitability. What it tells you is how much profit you squeeze out of your revenue. So the way we calculate it is net income divided by sales revenue. Here you can see Tiffany is 11.9%, i.e. 368 million divided by 3,085,000,000. So for every dollar of sales, you can say, we'll do this in a second, you'll see. Let's first calculate Walmart and calculate Ford, and I'll do it alongside you here